Okay, we know why we're here. As always, I'm more precise than Jonathan. And I don't even have to ask why me. I can be very specific and say, I'm not Steve Kaplan. I probably should be for a variety of reasons. I'd be better dressed, all sorts of things. Anyway, what are these, the motivation of this paper is pretty straightforward, right? I mean, when we look at LBO firms, one of the problems is a possible selection bias in the samples we typically look at, right? And these guys have an advantage. They've got some tax data, and everybody has to file a tax return. And so, really in what I'm going to do, I think the big question we have to ask is, when you look at this, there's usually trade-offs and things, and so is the benefit of having this universe of firms, is it worth the cost? Because we do, I think, and again, I think Steve would know, but I think we have a limitation on the financial variables that we would want to look at, and that we have to figure out whether that's going to outweigh some of these things, okay? So again, the main questions, what are the effects, real and financial, of LBOs, right? Are we creating value? Is the incentives of concentrated ownership or the control provided by that concentrated ownership, is that providing improved operating performance or improved investment? And on the financial side, do we have tax implications, or is it is it Newt's pillage and plunder explanation of these things that gives the gains to private equity purchasers? So very good. The questions are important. Okay. As was said, the sheer size of these things, right? And in my son's elementary school in Boulder, all the kids are talking about the performance of their private equity funds, right? I mean, that may be a biased sample, but you see, so a paper that I didn't write tells us that these private equity funds are actually outperforming the public markets over a long period of time. And it's not even the average. The median fund is doing better than the public equity markets. This is probably important here, right? And whatever's going on, if we're creating value, if we're transferring value, it seems like it ought to be pretty large. And this is something that we want to think about. Right? So what do these guys do? Well, I've sort of structured this so that I can just give a brief overview. The paper is very well written, so I thought the presentation would be good, and so I'll just intersperse my comments here. Right? So they look for improvement in operations, right? They look at return on sales, return on assets, and the EVA, and they don't find any. Right? There doesn't seem to be a lot there, right? Now, this is, converse to a lot of papers that seem to find substantial improvements in performance. And so this is one of the things that they want to investigate, is whether this is due to selection bias in the samples or what's going on. They examine change in total assets, and they find a small increase post-LBO, and it starts to fall off a little bit, but they conclude that this is not kind of an improvement in investments. We're not wiping out negative NPV investments from before, and so we're not doing that. Now, one of the things that seems unclear here, it doesn't seem like they can look at the composition of assets in these firms post-LBO with their data. Now, one of the things that I immediately thought about is, think about a wild example. Think about an extreme situation where you got a firm, it gets taken private in an LBO. It sells off all its assets, and all it has is cash. And let's just assume book value means anything, and so it sells it off for about book value. The change in total assets is nothing, okay? So, but there, we've completely solved the investment problem, but they would find exactly the same empirical results that they do here, and they conclude opposite, okay? And then now think about return on assets. So all I've got now is a pool of cash, and I've actually maintained my return on assets where it was before. That seems like a huge improvement relative to the risk and things like that that's going on. So it's not clear that when you look at some of the evidence that they've looked at, given the limitations of the data, that you can actually draw much of a conclusion relative to whether these guys are improving or in performance or not, whether they're improving investment behavior or not. And so here's one of the places where the limitation provided by this new data set may have that countervailing effect. Again, they look at dividends. They don't seem to find anything. So their conclusion is we're not stealing from the debt holders. They look at the trends in leverage, right? Obviously it jumps up, but then afterwards it doesn't decrease. Now, their conclusion there is that from this, it's kind of a change in target leverage or a permanent increase in leverage that these firms are trying to motivate. Just to remind ourselves that Kaplan found this in LBO firms that don't, or that stay private, that don't go public again. They don't seem to change their debt level either. But more importantly, it seems like a really expensive way to try to motivate an increase in capital structure, right? When you think about the attendant costs of, first going private in this LBO and all the fees that are associated with that, you've got the illiquidity of the investment, the possibility of under-diversification, and then these things are all, built to flip, right? So you've got to exit again. And so those are pretty large costs if all you're trying to do is change leverage. So it left me wondering. They do examine exit and they find some things, in terms that, that you'd kind of expect. More successful firms are more likely to go IPO and things like that. Now, this slide was originally titled "What I Want Them to Do," because really that's all that matters, since I'm the discussant. They don't tell us about management turnover. Which seems strange, right? I mean, LBOs are kind of a portion of the market for corporate control. Is this just an ownership play or is it a control play? It'd be nice to see something about that. They don't, given what seems like a real lack of data on dividends, one of the things they don't do, if you're looking for that story, is tell us how the bondholders fare. You could look at that over a much longer time period. If this is a pillage and plunder story, the bondholders and what they do and how they fare should tell us a lot about that. If it's a permanent change in leverage, right? Where are the tax benefits? Why don't, that's one of the things that struck me strangely, right? They've got tax data. They don't tell us the size of the tax benefits associated with an LBO. That's obviously something they're planning to do, so that's something of a cheap shot. But other things they don't do, for example, they don't provide any evidence that LBO firms compared to non-LBO firms are relatively under-levered. Is that the reasons that they're a target? There's no evidence there, right? And you look at the average LBO firm in their sample, pre-LBO, they've got almost 45% debt-to-assets ratio, right? Now, clearly these firms are from a skewed part of the distribution, but that doesn't jump out at me and say, whoa, under-leverage, just immediately. And again, they don't give an estimate of the cost in this change in leverage. What are these fees and all this stuff, right? And, if you think about the cost of an efficiency wage contract that would motivate managers to actually increase leverage despite the risk to their careers, that seems a bit extreme. Secondly, another thing they don't do is they don't look at leverage after exit, right? Nor do they break down their examination of leverage in terms of MBOs versus LBOs, right? Kaplan found some interesting things there. They didn't look at that. They don't look at whether these firms are maintaining leverage while they're private and then changing it when they exit. I mean, if that would tell us a lot about whether this is permanent or not. Okay, and then finally, something that again they said they were planning to do, it would be nice to see just an examination of both samples, right? Is there a selection bias by looking at firms that have, publicly available financial data? That would be a nice examination here. Some picky stuff. Their control for expected post-LBO performance, right? They use non-LBO firms. I mean, your paper is about selection bias. and you're comparing firms that somebody chose to take private in a leveraged transaction to firms that haven't faced that choice. That doesn't seem quite right. Heterogeneity in the motives. They look mostly at profitable versus non-profitable. It might be interesting to look at, you split the sample based upon, size, or something that predicts the presence of public debt, something like that. Or maybe something like management turnover. Again, right, split the sample according to whether management left or management was retained. That might be something that would be interesting to look at that. And then finally, you really want to find some way to include the duration analysis into the rest of the paper, because it's just kind of hanging out there. There's some interesting results that you might take it out and make it a different study. But right now, it's just kind of an appendage. And so really the conclusion is this, I think it's an interesting question to be asking. They take a strange approach, I think, in reaching their conclusions. They sort of say, okay, there's three things that it might be. They eliminate number one and they eliminate number three, and they say, well, it must be number two, but they never really follow up and say, okay, here, look, I can demonstrate that this is what it is in a variety of ways. And it seems like that would make this a much more powerful paper if you did that. Okay? All right, thank you.